You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Alfonso Peccatiello. He is back. He's the author of the free Substack newsletter called The Macro Compass. Alf, thank you so much for being on the podcast. It is great to have you back, but it's also great to have you back on Twitter and social media once again. So,
Hi guys. Hi Sri. It's a pleasure to be back finally after a few months of radio silence from my side. As I joked on Twitter, Alf is back. And I'm very happy to be back on your show first.
Thank you. And thank you for picking my show to be your return show. So could you give the audience a quick summary of your background, how you got into finance and sort of your career, but also, just touch up on, your leave from Twitter and, sort of the dynamics behind it.
Yeah, sure. So I started in finance basically 7-8 years ago. I'm a relatively young guy. I'm 30. Started when I was 23, soon after university. My background was in quantitative finance. So I'm half of a geek, not completely, just half. From early age, I was exposed to it anyway because my mother is in finance too. So I'm used to see charts at lunch table and all that stuff. So it got my curiosity to have an uptick already when I was a kid. Then I went into university, studied. And then out of university, I basically immediately started in the financial markets world. I always liked fixed income for some reason. There is never a good reason to like fixed income, but there are. It sounds like a place where you can get started, let's say, in finance, and it looks very simple maybe from the outside or very basic. But when you start to get involved in derivatives, it gets much more complex and interesting and nuanced, I would say. So I basically run different roles when it comes to portfolio management, mostly in liquid stuff, so government bonds, but also, of course, derivatives. And then 3.5 years ago, I effectively got promoted to run an entire book with a team. It was 20 billion, mostly fixed income, some credits in there, even some equities. Basically that's my journey, my quick, fast journey in finance so far. And effectively, I decided to stop that journey and start a new one. Already a year ago, I was, very active on LinkedIn, putting out some thoughts. Then I decided to move on Twitter, on Substack. I just enjoyed it so much to share my macro views and my thoughts with the world. And the engagement that came out of it was, very humbling. It was big, to be honest. I didn't expect that. And I just liked that so much that I decided that is what I want to pursue, at least where I want to spend most of my time. And, the radio silence over the last few months has been due to a couple of reasons, some personal reasons, some situations which were not very easy to solve. So I decided to focus and, reassemble my thoughts. And this couple of months have been useful to elaborate what I really want to do, what my priorities are. So to cut it short, here I am back in the game, not running an investment portfolio anymore, but rather, sharing my thoughts with the world.
Yep. And, it's great to have you back. Yeah. And, so since you've left, what has actually changed in terms of the macro environment as it relates to Feds, rates, and bonds?
Well, a couple of friends have joked because when I was in radio silence, one of my last posts on the Macro Compass, which is my Substack newsletter, had a couple of gems into that, as they say. So there was a suggestion as an investment idea for people who could do that, which was to play a flatter US curve. So 530s was the trade where you basically bet on the spread between 5-year and 30-year treasury bonds or swaps, whatever you want to do it, to flatten out.
Mm-hmm.
And that trade was basically the gist of my macro thought back then. The short answer to your question is that it doesn't, not much has changed, if not my central macro hypothesis has been validated, I should say. So when it comes to real growth, which we have seen basically peak out from the summer all the way until now in terms of the impulse of this real growth, this has actually happened, and this was the result of the credit impulse slowing down. For people familiar with my work, that's basically the second derivative or the pace of growth of credit creation. And credit creation is not money printing, but it's the amount of credit that gets injected into the private sector. So this is not bank reserves, but it's literally money that the private sector can spend. And this is not printed by the central bank, but by commercial banks and by the government when they do net deficit. So in 2020, there was a lot of it going on, and with a lag, the private sector had an incredible boost of aggregate demand, as you would expect when there is such a boost in credit impulse. This has seen a huge uptick in activity, in a real activity in Q4 20, Q1 21. Of course, the virus played a role there as well. And then in Q1 21, you had the perfect window of real growth. But in my macro compass, I already pointed out that this growth was about to fade away, or at least the impulse of this growth was about to fade away. Now, obviously, when you put the Federal Reserve that already in the summer started to slowly signal that they would get a little bit less accommodative than they would, you get this cocktail where the yield curve starts to flatten in my models, because effectively the short end of the curve starts to reprice tighter financial conditions, starts to reprice a more aggressive Federal Reserve, while the long end of the curve simply prices less risk premium when it comes to what will be the future path, long-term path of real growth and inflation expectations. Of course, if you tighten now in a very sharp way, while the credit impulse is already fading away, you reduce the uncertainty for what it will be the real growth and inflation expectation in the long term. Therefore, long and bond yields can remain relatively anchored, and as a result, the curve tends to flatten out. This is exactly what we have seen, and the trend has even accelerated over the last few days as Powell has come out of the trenches for political reasons that I would like to cover later, in my opinion, and has basically dumped the transitory story.
When you think about Powell sort of dumping the transitory story, and he's sort of changing the dynamic to raising rates. Is raising rates a good idea, considering that it's supply chains that are an issue? So if that's the issue, then shouldn't the Fed keep rates low so that they can allow supply to expand?
So Sri, and you're right. That's the answer to the question. But to make it a little bit more nuanced, Joe Biden faces midterm elections in November 2022, and those are pretty relevant because the result of these elections will shape his policy as he heads into 2023 and then eventually into 2024 with his potential second presidential campaign. Don't forget, Biden is effectively lower house and upper house now in the US as a result of the surprise Georgia elections in 2021. And of course, he wants to keep both. Now, if you are the president of the United States and you're facing a high single-digit year-on-year core inflation and headline inflation, while at the same time the median wage is not entirely keeping up with these inflationary pressures, you have median real wages, slightly declining, and over the long term, that hits the consumer purchasing power. This consumer is exactly the person who's supposed to vote you at the midterm elections to basically get the control back of both the Senate and the lower house. So when you are in that situation, politically speaking, the incentive is definitely to try and do something to put inflation under control, such that as the labor market naturally heals, and it will continue to heal into 2022, you get, a moderation of inflationary pressures and a slight uptick in wage growth. And as a result, real wage growth is supposed to recover and print in the positive territory. This will give people, additional purchasing power and additional tailwind to effectively feel more compelled, in my opinion, to vote for the Democrats in 2022. So these political incentives are obviously important when it comes to Powell, and it's, in my opinion, not a coincidence that soon after his renomination, which, as we know, is basically a political decision, he gets out of the trenches and starts to be much more aggressive when it comes to the transitory narrative.
Got it. And going back to the long bond trade, what a lot of people are curious about is there sort of an update on the credit impulse data? You were just talking about that a minute ago. So how's that playing out? And does the fact that we're seeing higher inflation right now, does that actually change the long bond trade at all?
So the credit impulse data work with a lag. Basically, if I have to explain that, if you are the government of commercial banks, and if commercial banks are lending out money, so creating new credit out of thin air, or the government is printing net deficits without the intention to tax those back from the private sector, they are extending credit or money to the private sector. Now, you need a little bit of time before this reflects into real economic activity, so both soft data and hard data, and then into different asset classes performance. This is what I showed multiple times in my work at the Macro Compass. Now, this time lag has effectively worked out pretty well because the credit impulse had basically peaked in Q4 2020 and then plateaued between Q4 2020 and Q1 2021. And therefore, with a lag of about 6 to 9 months, we have seen this plateau of real growth and then this deceleration of real growth that we had into the end of the year. If I look at credit impulse data more recently, but again, those will reflect later on in 2022, I still see a moderation in real activity. So the credit impulse has basically even moderated from the previous plateauing in terms of behavior. So that means that heading into the first quarter of 2022, maybe the second quarter of 2022, real growth is supposed to reprice down a bit, and on top of what we have already seen. Obviously, the counter argument to that is that the labor market will cyclically recover as we head into 2022. So perhaps this moderation will be shallow, but it will be a moderation. So you shouldn't expect major upticks in real growth when we head into 2022. And for when it comes to the long bond trade and the current inflation prints, that's a good question. Now, when you look at long bonds or 30-year bonds, you normally can decompose them in few things. And to make it very simple, those would be real growth, inflation expectation, and some sort of term premium. So if you start from the term premium, that's basically the premium that investors would require to own long bonds rather than to roll over short-term debt holdings or bills the whole time. So in a normal world, you actually require a premium to hold an interest rate risk and a duration risk against short-term bills. Now, this term premium has been for a while very much compressed, and basically, in my opinion, this is the byproduct of the uncertainty around real growth projections and inflation expectation projections going forward being very, very low. So before pandemic, you had effectively real potential growth in the US and distribution of probabilities of this real potential growth being very much centered around something probably slightly below zero. So let's say 1% real growth potential from the United States, which is just roughly speaking the sum of labor supply growth being mildly positive and productivity being mildly positive. That gave the result of about 1% more or less, give or take, real growth. And inflation expectation distribution in the US long term was also centered around core PCE being 1.25 to 1.3%, maybe 1.5%, and as well the distribution of probabilities being relatively centered to the mean of this distribution, and even having the left tail being relatively fat. So the risks of inflation printing close to zero in the US were priced in a much more aggressive way than inflation to print at 5% in the US on a sustainable basis. So that, together with the term premium, which was very low, gave as a result 30-year bond yields to trade, slightly below 3%, more or less. That was more or less the range, let's say 2.5%, maybe 2.5 to 3%. Now, if you look after the pandemic, in my opinion, you look at slightly different distribution of probabilities around real growth and inflation expectations. So the distribution of probabilities of real growth is clearly still centered into the mean. So the tails are pretty low, both when it comes to negative real growth and super positive real growth. But the mean of this distribution has moved to the left. So basically, I argue that R star and potential real growth in the US have actually gone down. In the US, but in Europe, all over the world, basically have gone down. Which means that if before I would have expected potential growth to be, 1.25%, 1.5%, maybe in America, I now expect this to be below 1%, actually very close to 0%. There are several models like the Laubach-Williams model that estimate R star, the equilibrium real interest rate, that actually point to the same result, about 0%. We can cover why that is the case, but then the distribution of probabilities around inflation post-COVID, this is very interesting because obviously you have a realized right tail in front of you. You have inflation printing at 6% year on year, and you have the government, which has proven to be very active when it comes to printing money, literally. So spending without having any idea to tax back from the private sector. And we have seen the private sector being relatively receptive when it comes to effectively receiving this money and spending this money, not in a complete fashion, but still relatively receptive. So then, as people have learned that the governments are pretty committed in fighting the left tail of this inflation distribution, they have naturally repriced the mean of this distribution to be a bit more to the right, so slightly higher median inflation expectation compared to before, but especially now the left tail and the right tail, so the deflation story and the, hyperinflation is a very punchy word, but the high persistent inflation to be more likely than before. Now, if you put these two parts of the equation together and you overlay a term premium that remains very, very low, and we can cover the reasons why that is the case, then you still end up with, a long bond that will trade probably, depending on exactly which part of the cycle you are, between 1.5% and 2.5%. And not much really has changed. And when the Fed becomes as a nominal, let's say, sum of this equation, when obviously the cycle tends to slow down and the Fed at the same time becomes much more hawkish and much more tightens financial conditions, then obviously you will go towards the lower end of the range. When the opposite happens and the Fed is truly behind the curve, and there is a lot of aggregate demand and the real economy is picking up steam and the impulse of growth is going up, then you go to the upper side of this equation.
And so, what are the signs that you're watching for right now to ensure that to sort of understand whether inflation is transitory or not? So is it just purely credit data, or does the fact that the government right now is running massive deficits, does that actually make a difference to the transitory inflation argument? Because at least from what we can see right now, the government does plan to run these massive deficits, say for the next 5-10 years, and sort of the political dynamics have changed compared to what it was in 2008. So does that actually change? The risk of having a secular inflation cycle as opposed to transitory inflation?
Again, a good question, Sri, but I'm not surprised. So let's see. On the inflation story, first of all, I have to point out a couple of things. If you talk about persistent inflation, then you're always looking at year-on-year increases, being able to keep up with the base of last year. So if inflation prints at 6% this year and the price index goes up from 100 to 106, then if you want to print 6% next year, your new base is 106. I just want people to understand that. It's very simple, but people sometimes tend to forget that price level is not the same as inflationary pressures measures as year-on-year inflation. So that is an important remark. Once that is clear, then the two main things I tend to look at when it comes to inflationary pressures, there are others, but there are obviously the credit flow, so the credit impulse that we talked about before, and obviously the political incentives behind, being able to expand this credit more freely than it was before. So we look at these as there are two actors that are able to do that, the government and commercial banks. Now, we've talked about the governments at length, but we haven't talked about commercial banks, and the net lending activity from commercial banks is pretty disappointing. And this will continue to be the case. The regulation is very tight. The return on equity on these loans is obviously very low because the capital requirements, that basically the capital you have to attach against a loan or every time you decide to lend out, is pretty prohibitive. So as a bank, effectively, as the credit worthiness of the private sector tends to go down, I mean, real cash flow generating activity and capacity is pretty shallow nowadays. Leverage has gone up massively. Regulation is very tight. The capital you need attached to a loan is very high. And the return, I mean, the absolute yields of these loans are also very tight because the risk-free real interest rate is negative in most places in the world, and the credit spread are kept extremely contained. So then as a result, loan yields are very low. Capital you need to attach it is very high. Credit worthiness of the borrowers not great. So why would bank be very keen to lend credit to the real economy? The government is, or has proven to be, but my point there is government has proven to be during a massive, unprecedented crisis that basically held no stigma to their action. I mean, we were in something that the government didn't create or couldn't take blame for. So that intervention was, in my opinion, much easier to justify than a large credit stimulus in the US, for instance, when inflation is already running at 6% year on year. That is not easy to justify politically. So if it's right, then let's say the put on deflation has become stronger, or governments have proved that they are willing to actually enter the system when the deflationary risks are becoming more alive. That doesn't immediately mean that the government will keep on pumping credit at any point of the business cycle. And we have already seen that they are not willing to. The new credit impulse coming from governments is pretty disappointing. And as well, I want to point out what's relevant here is the impulse. So it's the second derivative, which means that if you want to continue to print higher and higher year-on-year inflation data, then one of the components should be that basically the size of these deficits needs to be increasingly higher year after year to make sure that on an impulse basis you are delivering credit to the real economy such that you can beat the higher base effect you already achieved last year. That is, in my opinion, a pretty far-fetched base case scenario to assume, but the point as well, the other dynamic I'm looking at is the labor market. So labor market has materially shifted from pre-pandemic and post-pandemic, and basically the labor force, the active labor force, has shrunk, and most likely for good. Participation rate or total employment to population ratios, this kind of size of the pie, as I call it, so the entire labor market compared to the population have actually both dropped. Participation rate by a full 2 percentage points, that's pretty big. And despite the pretty strong cyclical uptick that we have seen in 2021 when it comes to activity, that hasn't recovered. So when the labor force becomes smaller, then, for good, then obviously you can assume that some wage bargaining power will be there from this labor force. So obviously, when people say the labor market is very tight, what they mean is the labor supply has actually shrunk and the number of jobs available out there is clearly increasing as there is a cyclical uptick. So therefore, there will be some wage bargaining power. That is actually correct, I think, as an assumption, especially short term and especially when the cycle is roaring, which used to be the case in 2021 and much less, in my opinion, going forward. But what people tend to forget is, please step back and take the big picture. The labor pie, the labor supply, let's say that the pie of labor, available labor to the economy has shrunk. So this means that long term, your potential to actually grow is probably lower than what it was before. Ceteris paribus when it comes to all other components, but it's important to consider that as well.
Yeah, but I think when you mention the labor force, you actually bring up a very interesting point. So the labor force is sort of made up of sort of average Americans. And do you think that if the Fed, say, doesn't act at all under the presumption that, lower rates would increase supply and therefore would cause inflation to be transitory. So if the Fed actually acts under that, and let's say that ends up being false and inflation ends up sustaining itself for another year, do you think the Fed's credibility among the average American goes down, considering that they usually expect these policymakers to act. So is there actually a threat to Fed credibility here?
Once you come out of the trenches and you say that transitory is not the word anymore, and therefore you make your mandate more, let's say, firm when it comes to achieving your price stability, and now you are clearly upshooting your price stability, and also medium-term inflation expectation surveys and also inflation break-evens when it comes to five-year, for instance, are pointing to relatively mild, but still a persistent upshoot of your inflation mandate over time. When you come out of the trenches and you say, yes, I hear you, yes, I see you, when I see that there is this problem and I want to fight the upside part of this price stability mandate, and you act straight, and then you do not solve it, then yeah, I guess you might have a communication problem. I don't know whether a full credibility problem, but at least a pretty serious communication problem.
Yep. And I wanted to move on and talk a little bit about QE as well. And so, we both sort of agree that QE is not inflationary, but is QE by itself deflationary or disinflationary? Or, what are the actual impacts of QE?
So I would argue that your question is interesting because you take, of course, QE as a separate phenomenon from everything else that happens in the world. So you're asking me to isolate basically one component, but I'll do my best. So in a world where other agents are neutral, let's assume, and then we have QE going on, then the impact of QE long-term is mildly disinflationary and mildly reducing real growth as well, I believe. So the reason for that is, if we try to look at what QE does, it's basically the central bank saying to the private sector, I am going to swap the composition of your asset side from bonds and, okay, let me say cash, it's a big word again, but bond and short-term fungible versions of cash into less bonds and more short-term instruments. Okay, those short-term instruments are bank reserves. So that's what the central bank does. It forcefully swaps the asset side of the balance sheet of the private sector. Now, the private sector really at that point ends up owning less bonds as a percentage of their total assets, let me put it like that. And the private sector has, because of regulation and because of the construction of our system, an inherent appetite to own assets and to own duration risk, interest rate risk on the asset side. So just think of pension funds, insurances, banks. All of those are naturally exposed to interest rate risks and want to own, sometimes have to own most of the times because of regulation, some instruments to make sure they both generate a return and they, let's say, cover their interest rate risks on the asset side. On the liability side by buying on the asset side. So, these bank reserves are now substituted when it comes to, for example, the commercial bank, and now substituted this bond portion to a margin. When it comes to a pension fund, then the pension fund doesn't have bank reserves, but ends up having a deposit on the asset side at a commercial bank. And then the commercial bank will have, the offsetting bank reserve and all the accounting that comes with it. But the point is, all these private sector players end up having less bonds than they had before. And they might have a natural appetite, or they might be forced by regulation to own assets.
Right.
So if you're a commercial bank, then you will have bank reserves. Bank reserves cannot, are not, will not be lent out. That's not how it works. The entire system, it's not how it works. So bank reserves can be redeployed into financial assets under certain conditions. And those financial assets and the mandates that commercial banks have are very tight, again, because of regulation. So the obvious gateway from rebalancing your portfolio back again would be, again, bonds. Then will be credits, some form of credit, some corporate bonds are, obviously eligible according to the regulator to own in your asset side if you're a commercial bank. So in order to rebalance back your portion of bonds to generate a return and to cover your interest rate risk, you will buy back bonds. They can be credit, they can be government bonds. The pension fund and the asset manager will do something very similar with their bank deposits. So they will allocate some of these bank deposits into some risk assets again. That's again for the same reason, either regulatory or to generate some return or to hedge some risks. some of them, only some of them, can only also increase their equity exposure a tiny bit.
Yep.
So, basically, what I'm describing is what's called the portfolio rebalancing effect, but it's just the byproduct of what QE does. I mean, once QE forcefully swaps you back to more zero duration instruments, zero risk instruments that are bank deposits, then you will try to do something with it. Now, at some point, this something will lead to capital misallocation. And the whole system will continue to increase its leverage. It's how it's designed. Credit will continue to expand. Real interest rates will continue to be kept lower and lower by design or by monetary policy. Credit spreads will compress to a point where capital is simply misallocated. So we buy high yield spreads at 250 over, or we do not disentangle anymore idiosyncratic risks. We just buy a basket of stuff because we just need returns. And that's basically why I think over the long term, quantitative easing, if taken alone, again, your question is just look at that component, might be slightly disinflationary and slightly negative for potential real growth.
Yep. Yeah, I think that was a great explanation. And one thing that you've sort of talked about that I've seen like on your Substack and just in general is sort of you talked about real yields going up for healthy reasons, and then you talk about real yields going up for what you say wrong reasons. So could you sort of talk about the difference between what healthy reasons are versus what wrong reasons are?
Yeah, so it's one of the centers of my macro framework. So on the macro compass, you have basically two axes, and one of it is the global credit impulse, and the other one will be risk-free real interest rates against, let's say, an estimate of what the equilibrium real interest rates should be. So if this difference is positive and real rates are higher than the equilibrium, that is normally a bit of a headwind for risk assets. Otherwise, if real interest rates are below this equilibrium, it's actually positive for risk assets, normally speaking. So there are situations where real interest rates slightly above the equilibrium real interest rates, or anyway in a rising trend, can be healthy, as you said before. I said it a couple of times. And that happens when, let's say, it's early 2018 or early 2021. So that happens when you have a strong cyclical upswing, which is driven by a healthy boost in aggregate demand, which seems to be sustainable for at least a few quarters down the road. So you're basically having, let's say, a conjecture where you have a cyclical upswing, you have monetary policy not being yet overly tight, and then you have basically a situation where from very low real interest rates, you move to slowly up towards your equilibrium real interest rates, maybe slightly higher, but not much. So that happened in late 2017, early 2018, for example. China had printed a huge credit impulse in 2016. The world had done something else on top. In 2017, you had pretty much a synchronized global growth, if you remember. So we had even Europe growing. I think real GDP was close to 3%. Oh my God, something incredible for us Europeans. And then you had Trump on top coming in with tax cuts. So again, credit stimulus. On top of an output gap estimated to be already very thin and a labor market to be already pretty hot back then. So then in 2018, the first half, you got as well the US tailwind. Now, when that happened, real interest rates moved from very low levels to, slightly higher levels. And this was the result of this cyclical upswing, which lasted a few quarters, where, central bank was not yet overly tight and aggregate demand was actually getting a relatively sustainable boost. And that's one of the scenarios where real rates can move up without causing too much damage. In 2018, as you remember, real yields at some point moved too much up, and then they caused quite some damage. So when 10-year real interest rates in the US went to 1%, that's about Q4, I remember November 2018, and the effect of the Trump tax cuts and the Chinese credit impulse stimulus were actually fading away, then this combination became toxic. And on autopilot, Powell comment actually didn't work very well, and the market had a drawdown of about 20%, if you can remember. Now, real interest rates at that point in Q4 2021 were moving up for the wrong reasons. So remember, the good reasons is late 2017, beginning 2018. In September, November 2018, real interest rates moved from, I think, 70 basis points to 1% or 1.2%. They had a 40, 50 basis point up in America. to levels which were already above the equilibrium real interest rates, which back then I estimated being, around 0.5% in America. So they were already moving dangerously higher than the equilibrium real interest rates was. And we didn't have a cyclical upswing anymore. We had actually the credit impulse had faded away, Trump tax cuts effect had become to fade away, and the Federal Reserve started to become pretty hawkish on top. So at that point, you are in the situation where real interest rates uptick becomes dangerous. So it's bifold, and you need to interpret several other situations around you, but it can be both going up for healthy reason and not for healthy reasons.
Got it. Now I wanted to move on to a completely different topic, and wanted to get your thoughts on how deleveraging would work under the current environment. So under the current environment, what we've got macroprudential regulation, we've got capital requirements like Basel, but we've got poorer liquidity conditions because the banks don't have prop desks anymore after Volcker and Dodd-Frank. So how would a deleveraging cycle be different now compared to, say, pre-2008 or 2000, for example?
Well, it wouldn't work. It just wouldn't work. So we have attempted deleveraging in Europe, but also in America a couple of times. So this came generally with the austerity, which at the end of the day is just the government effectively draining resources from the private sector. So it's the exact opposite of credit impulse. It's credit slowdown. I don't know how you want to call it, but it's banks not lending and the government decided to drain resources from the private sector. We have tried it a couple of times and we have realized the population doesn't like that too much, I have to say, after a while. Also, the system is not designed for that. Our system is a credit system, basically. So it's our monetary system is based on credit creation, full stop. So that's what humans have always done, especially after the 70s when all the bets were off when it came to gold standard and the likes. You had absolutely nothing stopping you from creating new credit from a commercial bank perspective or from a government perspective. So deleveraging is just poisonous to the system. It's sometimes a rebalancing exercise that basically brings the amount of credit available to the system slightly lower, but it can't get any more intense than that. I mean, the system is designed to actually increase leverage to have the perception of wealth creation and the perception of growing above our potential. I mean, if I tell you what potential growth is in Europe, in real terms, it's in some places likely to be negative.
Yep.
It is just not foreseeable and not politically acceptable to have negative real growth for several years in a row. It's just not acceptable. Therefore, we resort to the very core of our monetary system, which is just a credit-based one. And therefore, deleveraging is just, contrary to the design of the system.
Got it. And, from that standpoint, so you mentioned that, some places in Europe probably have, negative real growth. And, in the short term, there's no risk to the euro disintegrating. But do you think in the long term, that's sort of definitely a big risk to the euro disintegrating because, governments would rather have the option of printing money and, trying to solve some of these problems as opposed to sticking the euro and allow the ECB, which is sort of a central bank where different countries don't have control of their monetary policy. So do you think in the long run, this negative real growth phenomena is a risk to the euro area disintegrating?
So this is a geopolitical question, basically, because I always try to look at the incentive scheme of decision makers in general, wherever we are in a business, in the world, in monetary policy, in politics. And in this case, the incentive scheme of the different actors in the Eurozone is very interesting because there are Austrian economics countries, let's say, the northern countries or the frugal countries in Europe. So Netherlands, Germany, Austria, Finland, all these guys, they have a certain perception. So that this used to be in the past is bifurcation between, the spending in the south and the austerity in the north, or at least the vision of our fiscal policy should be around. It's now arguably a bit more nuanced across Europe. So you have a European Recovery Fund, which is a timid, shy step towards something that looks like a fiscal union remotely, or at least that would be the first step. You have France, which basically serves as a balance, let's say, as a balanced actor within the Eurozone, that also tends to, embrace a bit more fiscal stimulus and a bit less the austerity camp. Elections in Germany was, of course, changed a little bit the situation there too. But ultimately, when it comes to the dilemma of will European countries be better off separated than they are together, the real question is who benefits from that? I mean, who will take the initiative to literally leave the Eurozone? Who will take the initiative to then deal bilaterally with superpowers like China and the United States, rather than dealing with them as the European Union, which in my opinion, doesn't do a fantastic job, but probably does a better job than Greece alone would do, for instance, just from a simple, geopolitical power perspective. So it's a house of cards. It's an incentive scheme problem, and Italy has, of course, threatened in the past with some less European-friendly governments to actually go out, but ultimately it's just some sort of blackmailing, and the Germans have been very tough and the Dutch have been very tough, but when the decision point comes, the geopolitical incentives are just too strong, I believe, for Europe to stand together, not to talk about target two balances, which are another inter-European problem, that is the design of having different countries with different local central banks, different fiscal, etc., etc.
Yeah, and when you talk about what the governments have done post 2020, is post like COVID 2020? So would it be correct to call it MMT? And in general, what are your views on MMT? Do you think or would you say if we actually implemented MMT, we would actually see sustained long-term inflation?
Wow. My views on MMT, let's say. So there are certain aspects of MMT that I think are pretty interesting. So first of all, in general, the MMTers get that, credit creation is part and is the backbone actually of our monetary system. So they understand that, the government and commercial banks, and especially the government from their perspective, plays a big role when it comes to injecting or not injecting resources into the private sector. So that's the positive part. You have to give them credit that they've at least shed light on this topic and opened the discussion that the government's balance sheet does not work as a household's balance sheet. And that is something that was pretty much clear to me always, but it's to be honest, not clear to the public opinion. Pretty sure about that. And if I have to be frank, not clear to most finance practitioners too nowadays. And I don't blame anybody. I mean, that's what we get told at university, that the government balance sheet is just the same as a household's balance sheet. That's not the case. Now, they have at least, shed some light on the topic and engaged in discussion. The full-fledged MMT, where effectively that lever is almost the only one that regulates basically the level of aggregate demand and the level of the balance basically in the private sector and in the economy, such that you can basically decide to use taxes when you want to slow down economic activity effectively, and all the other more pushy MMT views. Well, those are just more pushy. And to the people that are saying that we are getting there in terms of operations, no, that's not the case. That's not the case because you see already, for example, in the UK, that people are looking at it by saying, but we need to reduce our debt levels. We need to tax the private sector. So let's talk about taxes. And let's basically rebalance the system as it was before. Let's bring it back to a level where we can reduce debt levels, and the full-fledged MMTers wouldn't just care too much about debt levels, because brought to the extreme, that's not even relevant anymore.
Got it. And from a trading standpoint, how much of the market is actually driven by short-term flows versus long-term macro fundamentals?
So that's basically, if you're an investor, I think you need to respect both. So the way I do this really is long-term macro fundamentals will still prevail over the medium term. So the reason for that is that the humans tend to allocate capital ultimately where they see an opportunity in the medium term. Now, obviously, as we have seen in 2020, things can get extremely confusing and extremely blur in a few months, and that's the result of excessive leverage. That's the result of no risk-taking abilities no warehousing abilities, basically by market makers because of regulation or business models have changed. That's the result of basically micro factors and liquidity factors, effectively. And those can be paramount important and can be compounded by human behavior in the short term. So you need to respect and understand both, understand positioning, understand the micro mechanics of liquidity and how the market works. But I would say over the medium term, so let's say 5-year plus, then I believe that macro fundamentals remain the main driver of a relatively rational investor, which I want to hope everybody tries to be.
And what's your best advice to a trader and investor looking to build a macro trading process or frameworks? What are some things he or she needs to know?
Okay, so I would say, first of all, do not be shy when it comes to deploy your time into understanding what drives forces in the world, economic forces in the world, and the monetary system. So that means before rushing to conclusions, rather understand the basics and really how the monetary system works and how the private sector works and how the government works, et cetera, et cetera. It's really a journey and it can take you years. And if you want to rush into conclusions because you sort of have a recency bias or maybe a reflexivity bias, you really want to be long Russell, and therefore you're going to form your macro opinion on, I have to be long Russell because the real economy is exploding. This reflexivity bias basically is something that I see very often. And so my suggestion would be really try to make a step back and look at the world from really 10,000 feet. And then, you can have your own macro perspective. It doesn't need to be the same as mine. Otherwise, we wouldn't have a market in the first place. But really try to do the deep work first. And then slowly but surely, the pieces of the puzzle will come together. And ultimately, you will have a more structural macro view. And then you'll have to overlay the cycles on top. And then the second advice I would always give to anybody is, please stop out. Stop out of your ego. Stop out of your conviction levels. You will be wrong. It's just part of the game. I am wrong about 50% of the time, slightly less when I look at my investments, basically. So the story is that as long as your positive investment decisions will work for you for the long term, so you will not rush to take profits on those, the profits that you will make on the winning bets, let's call them like that, will by far be larger than the losses you take on the wrong ones, as long as you stop out. Mm-hmm. And once you run your P&L analysis at the end of the day, which is simply number of profitable trades times the P&L minus number of negative trades times the P&L, the only thing that matters is that that number needs to be positive. And trust me, you cannot limit the number of negative trades. You will be wrong. Your win ratio will be, between 40 and 60%, whatever. But it's really the humbleness to be able to stop out even of the so-called ego trade. Yep. The ego trade is the one where you are really convinced that's it, nothing can change your mind. And those are the most tricky to handle when it comes to stop losses, but please stop out anyway.
And what are your favorite books on markets and macroeconomics? And just in general, what are your favorite books?
So shout out to Cullen Roche with his, oh my God, what's the name of his book again? Now it's slipping my mind. It has a red cover, Pragmatic Capitalism.
Yep.
Something like that.
Pragmatic Capitalism, yeah.
Yes, and that's a fantastic book. And so So when everybody asks, I think Cullen gets a lot of publicity from me, but he deserves it. It's a very good guy, and it's a very simple book, up to the point, helps you understanding the basic of our monetary system. It's a very short one, I think 100 pages or so, definitely a buy. And for the more long-term thinking, when it comes to macro fundamentals, I would say Holy Grail of Macroeconomics is a very good book. And when it comes to, let's say, the more experience in investing or trading, or how people think about the risk-reward ratios and the risk-return profile of their portfolios, then I think the Market Wizard series of, I always forget his name, but the Market Wizard series is actually a pretty interesting one. Just buy all the book from these guys, because the interviews in there are absolutely worth your time. Worth your time, definitely.
Awesome. And, to wrap up the podcast, I wanted to ask, what's next for Alf? Now, you've sort of dedicated your time to, spending more on Twitter, more interacting, and, more writing Macro Compass. What's next?
It's a question I can't answer by myself too at the moment. So the only thing that I know is that I've enjoyed the journey of being, writing the Macro Compass Substack newsletter and pushing out my thoughts on Twitter, LinkedIn, and any other platforms, and engaging with the audience, doing podcasts, so much that for the time being, I'm going to focus on that. What comes after, to be honest, I really don't know. I am just very happy to be back, and I just look forward to, continue pushing out content that people will like, and continue engaging in, high quality interactions like this podcast. To be honest, that's been, a great pleasure to be on.
Awesome. And is there anything that, we didn't cover that, you wanted to talk about?
If I look at the current market dynamics, then basically, I just want to wrap up what I think it's not on people's radar. And what's not on people's radar is that real interest rates will probably gently go up in 2022. So we have been used to seeing interest rates drop relentlessly. We have 5-year real interest rates in Europe at -2%. We have had them in America as well at -2%. And I don't believe that this will be the case again in 2022. I think that nominal interest rates are, especially at the short end, repricing in a correct fashion. The Federal Reserve incentive scheme is completely different than what it was in 2020 or 2021. The political incentives are different. The labor market will slowly heal, and despite the credit impulse not being incredibly optimistic, you probably will grow at or slightly above trend when it comes to real growth, because again of the labor market uptick. So the Federal Reserve will have to use this window to try and tighten up. And nominal interest rates go up. I also expect inflation expectation to slightly drop from current levels. So the combination will be, for higher real interest rates, which I want to stress out again, people have not seen that happening for, quite some quarters now. And as real interest rates go up, there are different things that change in different asset classes, right? I mean, then equities start to behave in a certain way, and then which sector behaves in another way. What I can say is the 2018 playbook, especially the, third quarter of 2018 playbook, that's, I think, a good start if you want to understand the next few quarters, I would say.
Awesome. With that, thank you so much for being on the podcast. It was wonderful having you. It's great to have you back. It's great to, it's great to have your comeback episode on my podcast. I'm very honored to do it. So thank you for being on.
Thanks, Sri, and keep up the good work. I'm very impressed by what you do. Just keep it up. We're all big fans of you.
Thank you.